Okay, real talk for a minute, because unless you have $1.6 million saved, most retirement plans assume you'll work till 67, maybe even 70. So the message is pretty clear. You either have a massive nest egg or you're in it for the long haul. But retirement for Gen X, it's not that black and white. In this video, I'm going to show you several ways that you may be able to stop working at 62. Not by becoming rich, but by eliminating the need for a paycheck and simplifying a few things before you get there. Because if you're in your 50s right now, this is the window where these types of decisions matter the most. But first, we're going to clear up a few things that the retirement industry gets completely wrong. And then we're going to start building that plan. So let's go. Okay, the first point is the lie you've been told. Here's the first big myth, that you need $1 million to $2 million to retire. That number paralyzes people, and it's mostly irrelevant. What you actually need is enough to cover mandatory expenses, such as housing and insurance and food and transportation. And yeah, a little left over. And the second big myth is that you need to delay Social Security in order to have enough money to survive old age. And that advice assumes that you can continue working, that you like your job, and that you want maximum lifetime dollars. But if the goal is no more grind, then delaying Social Security forces you to work longer to cover that gap. So the pivot is the age 62 bridge strategy, not the wealth maximization strategy. There are plenty of other YouTube channels that specialize in that. Okay, escape plan step 1. By 62, all of those mandatory expenses need to be covered without the need for a job. And that starts with the biggest one that most of us have. Housing is usually the biggest expense that you'll have in retirement, whether you own or whether you rent. But let's cover two different situations here, and I'll give you some options in each of them. Okay, the first one is you still have a mortgage. And you've probably heard conflicting advice on this one. Some say, don't go into retirement with any debt, including the mortgage. Pay it all off beforehand. Others say, don't struggle to pay off a mortgage and sacrifice all of your liquidity, especially to pay off a mortgage loan with an interest rate below 5%. And both of those sound very intelligent. Now let's say you have a $1,500 a month mortgage, which is around $18,000 a year. To safely generate that amount of money without draining your savings, you would need an additional $300,000 saved, invested, to cover that amount. So you can see that by reducing or eliminating the mortgage beforehand, of course, it's going to drastically lower the amount of money that you need to survive on. But there's an important caveat, and that is don't wipe out all of your savings just to pay off the house. Early retirement, and retiring at 62 is considered early retirement. It's fragile without having that cash and liquid savings that you can survive and pull from. Having that cash to live off of in early retirement gives you so many more options. But if you tie it all up into paying off your mortgage or paying down your mortgage, you've lost all those options, because you still need that liquid buffer for things like home repairs, unexpected medical bills, insurance increases, or just market volatility. So for some Gen X homeowners, the smarter move may be to keep that manageable mortgage, but build a strong cash and investment cushion alongside it. In other words, the real goal isn't to have no mortgage. The real goal is simply to be able to afford your housing costs enough that you can survive without a paycheck. And that might mean paying off the mortgage early. It might mean refinancing it, or relocating to a lower cost area, or downsizing. It might mean any of those things. Different paths, same objective. Just make housing affordable enough, if you can, that it no longer controls when you can retire. Now let's talk about the second situation that many Gen Xers may be facing. Okay, the second scenario is you may be going into retirement as a renter, and renters can't eliminate housing costs, but there are ways to control it. Is there a way that you can cut your housing costs 30% by the time you turn 62? Could you downsize and get a smaller place? Same thing as I was mentioning in the homeowners section. Can you move to a lower cost of living part of town? If you're not working anymore, maybe you don't need to live within the city limits, where rents are almost always higher. If it's just you and you're single, would finding a roommate situation work out? Especially if they have the same financial and retirement goals as you do. Dropping your rent by $700 a month, that frees up $8,400 a year, which reduces how much income you need. And we don't know how volatile rents are going to be over the next 30 years. Just like we don't know what homeowners insurance and property taxes, what they're going to do over the next 30 years. But as a retiree renter, here are just some things that you could possibly consider. Look for the smaller, independently owned units or complexes instead of those huge property managed ones. Also, consider keeping your possessions a little leaner. You don't have to be all out minimalist, but if where you're at, they raise your rent too much, then you're in a better position to where you can move. And it's much less of a headache when you have less stuff. Also, if your complex or where you live, if they have a website and they post their current rental rates on that website, make it a point to get on there regularly and just kind of stay aware of what they're charging new customers coming in. Because if it goes lower than what you're currently paying, that's your signal to negotiate with them or find out if they won't negotiate, and then you can decide what your next move is going to be. And another thing is to just expect that rent will probably increase year after year. It usually does. Expect a 5% rental increase each year. Now, of course, it could be a lot more than that, but if you can at least expect that, maybe budget for that. It won't come as much of a shock. But let's also talk about some other landmines, because after housing, these three expenses, if not managed properly, they could mess up the whole plan. And one, that's health insurance and related health costs. Two is transportation, and three is debt. Now, health insurance, it's a big one. And that strategy for retiring at 62, you've got to have some kind of a health insurance plan to cover you until 65. And what that can be is a high deductible ACA plan that just gets you through those few years until Medicare. Now, for auto expenses and transportation, consider going down to a one-car household. It's amazing how much money you can save that way. And it doesn't have to be permanent. It could just get you through these lean years. Now, let's talk about debt. We already talked about mortgages. So what else is there? Gen X leads student loan debt balances of all the other generations. So I know there are a lot of you watching that are still dealing with student loan debt. Of course, there are personal loans, there's credit card debt, and these are the kind of debts that you don't necessarily want to go into retirement with. These are the kind of debts you do want to wipe out. And what would it take to do that before 62? If you became obsessed with making that a reality, to make those debts history, what would it take? Would it take an extra job? Would it take a roommate, someone you can charge rent to? What about babysitting your grandkids? Why not? Because I am sure that you can offer them a much, much sweeter deal than they would pay with daycare, and a much better experience as well. Just even, small income streams coming in can accelerate getting rid of those debts. And it can dramatically shorten the timeline to getting those paid off. Okay, let's talk about escape plan step 2, the Social Security bridge. Because once you get all of those mandatory expenses under control, the next question becomes, how do I want to bridge that time between 62 and 65, or 62 and 67? And for Gen X, there are 2 realistic paths. One is to claim Social Security at 62 or any of those ages leading up to it. And this is the simplest version of the plan. Not as much prep time needed for this one. You start Social Security immediately at 62, and you use that money to cover the majority of your expenses. So for many Gen Xers, that 62 claiming amount averages around $1,500 a month. And the advantages, they're obvious. The income starts right away. It's less pressure on your savings. I already mentioned it's not a whole lot of, planning that has to go in beforehand. But, there are trade-offs. Your benefit is permanently reduced compared to waiting to full retirement age at 67. And if you live a really long time, that lifetime benefit will more than likely be smaller as well. And to make this version work, you typically need low housing costs, very controlled expenses, and some savings as a buffer. But let's talk about option 2, the bridge strategy. And I did a video on this particular strategy just recently. But this is where you still retire at 62, but you wait to claim Social Security until age 65 or 67. So instead of claiming Social Security immediately, you use your savings to live off of, to pay those mandatory expenses until you reach that later claiming age. And that money might come from your cash savings. It could come from Roth IRA withdrawals. It could also come from modest withdrawals from your tax-deferred accounts like your 401k. And I say modest because we don't want to take out too much to inflate our tax burden, especially in this early retirement window that we're talking about here. Now, the advantages with this one is that your Social Security check, it'll be larger later, and your lifetime income could be higher. But the trade-off is risk, because you have to have enough savings in order to cover a few years of living expenses without a paycheck coming in. Now, of course, if you find yourself, in a crisis mode, you can claim Social Security after the age of 62 at any other age. It doesn't have to be just 62 or 65. I mean, it could be, 63 and a half or 64 and a half when you claim. But the idea with this plan is to postpone claiming till as long as possible, but still enjoying the fruits of being able to retire at least by the age of 62. Now, I know that some people, they're psychologically, uneasy about spending that much money from their savings that early in their retirement. And, I get that too. So the goal is now, when you're thinking about all of this, is to find out which of these options better lines up with your goals. Which of these options better resonates with your personality, your comfort level. Okay, let's just quickly recap here. Because if your goal is to quit working at 62 and you don't have that massive nest egg, then first, find a way to get your expenses as minimal as possible. And secondly, decide on what you're going to do. Are you going to claim Social Security at 62, or are you going to use cash to bridge you to a older claiming age? And lastly, if you find yourself overwhelmed by the expenses or the debts in your life, coming up with a plan that gives you a better future than the one you're thinking of right now. So you tell me, what is the biggest hurdle that you see that could prevent you from retiring at 62, if that's your goal? I appreciate you watching and hanging out with me today. Before I go, I've got some 40-year-old wisdom from Whitesnake that I thought really just kind of fit this video. And I've made up my mind. I ain't wasting no more time. All right, that's it. Have a great week. I'll see you in the next video. Bye.